Welcome to this explainer. Today, we're mapping out the real-world journey of business assets. We're going to completely unpack the mechanics of depreciation, literally following an asset from the day you acquire it all the way to its final disposal. It's kind of like a biography, but for equipment. So imagine you buy a $50,000 truck for your business. Does your company instantly lose 50 grand in profit that year? Well, no way. You don't just take a massive hit on day one. Instead, we rely on this brilliant accounting solution, the mechanics of depreciation.
We're going to follow the complete life cycle of an asset through 5 logical stages today. First up, the real cost of assets. Second, why assets actually lose value. Third, calculating that drop in value. Fourth, how to record depreciation correctly. And finally, saying bye-bye with asset disposal. Let's get right into it.
Section 1. The real cost of assets. Let's make sense of this expense.
All right, so at its core, depreciation is simply a non-cash operational expense. You are basically using up an asset's economic juice over time. And this is entirely driven by what accountants call the matching principle. Think about it. You buy a machine to generate income over a bunch of years, right? So it only makes sense to match the expense of that asset to the revenue it creates in that specific year. You use a fraction of the asset to make money this year, so you only claim a fraction of its cost as an expense this year. Absolutely crucial to understand.
And that brings us right to the prudence principle. Now, accountants are famously conservative, and as a rule, it's always safer to underestimate your wealth. By systematically lowering an asset's paper value, businesses avoid artificially inflating their profits. Why does that matter? Well, it prevents owners from making excessive cash drawings, taking out money the business actually needs to survive down the road.
Section 2. Why assets lose value. Let's look at the actual forces of depreciation. So the value of an asset usually drops for 4 main reasons. First up, economic factors. Think obsolescence. Like when a newer, significantly better computer model hits the market, making yours practically a dinosaur. Second, time factors. This is basically the ticking clock of a legal lease expiring. Third, we have physical factors. Your standard wear and tear, rusting or erosion over time. And finally, depletion factors, which happen when you're literally using up natural resources.
To put that last one into perspective, take a look at depletion factors. A mine is a perfect example. It physically consumes its own inventory as materials are extracted from the earth. As those resources vanish, tons at a time, the mine's value is tangibly depleted in real time until its economic life is totally spent.
Moving on to Section 3, calculating the drop in value. It's straight line versus reducing balance.
When it comes to the math battle of estimating this drop in value, we typically pit 2 main approaches against each other. On one side, we have the straight line method, which charges the exact same steady expense every single year. And on the other side, the reducing balance method, which heavily front-loads those depreciation expenses into the early years. Let's look at how this plays out. If we apply both methods to the exact same $16,000 machine over 4 years, the journey looks completely different. Straight line, it assumes a steady, flat drop of $3,750 every single year. But a 50% reducing balance aggressively targets early value. It drops a massive $8,000 in year 1 alone. They both end up at a $1,000 residual value, sure, but the pathways to get there diverge wildly. Now you might be wondering, why on earth would a business want such a heavy expense drop right out of the gate? Well, vehicles are the perfect candidate for this. Their economic usefulness is just way higher when they're brand new. As they age, they naturally need more frequent repairs and maintenance. So by pairing a high depreciation expense early on with a lower depreciation expense later, you neatly balance out the total cost of running that vehicle over its entire life. Let's step through the math on a $6,700 vehicle using a 20% reducing balance. After subtracting that year 1 expense, we land at our new net book value of $5,360. Now the absolutely crucial part is year 2. We don't take 20% of the original cost again. Nope, we take 20% of that new, lower remaining value. Because of this, the expense shrinks every single year.
Section 4, recording depreciation correctly, because consistency is key.
All right, once you pick a method, you have to stick with it. Consistency keeps our ledgers comparable year over year. To do this cleanly, we actually separate the records into 2 distinct accounts. First is the non-current asset account. This one has a debit balance and it forever holds just the original historic cost of the asset. It never changes. Second is the provision for depreciation account, which carries a credit balance. Think of this one like a basket that just stockpiles the growing estimate of used-up value charged every single year.
So, what does this all mean? Well, by comparing these two accounts on the statement of financial position, we arrive at a critical number, the net book value. You calculate this simply by subtracting the accumulated depreciation in that provision basket from the historic cost over in the asset account. The resulting net book value, that represents the true, current, estimated remaining worth of the asset to the business.
And finally, Section 5, saying goodbye. It is time for asset disposal.
Look, every asset's life cycle has to come to an end eventually, and that is the moment of truth for all our accounting estimates. To clear the books, there's a strict procedure. First, we transfer the original cost from the asset account to the disposal account. Then, we transfer the accumulated depreciation over to the disposal account as well. Next up, we record the actual cash proceeds we received from selling it. And finally, we balance the disposal account to discover the ultimate truth. Did we make a profit or a loss?
It's pretty straightforward. A profit on disposal happens if the cash sale proceeds are higher than our estimated net book value. A loss happens if the proceeds are lower. But here's the kicker. Because depreciation is really only a best guess throughout the asset's life, the disposal account almost always reveals some kind of discrepancy. We get a final profit if we overprovided depreciation, meaning we guessed it lost more value than it actually did, or a loss if we underprovided.
And reality can bite hard. Take a textbook example of an asset that originally cost $5,500 but was eventually sold for just $2,000. This triggered a $2,400 loss because the accumulated depreciation over the years was sadly underprovided. The business's books basically assumed the asset held far more market value than it actually did when push came to shove. Ouch.
Well, that wraps up our explainer on the asset life cycle, but it leaves us with a really critical question to ponder. Is your balance sheet truly reflecting reality, or are your estimated assets hiding a ticking depreciation time bomb? Keep questioning the numbers behind those estimates, folks. Thanks so much for joining us.